From 1900 to 2010, the world encountered several economic recessions, among which the 1930s Great Depression and the 2008 credit crisis are said to be the two most severe economic meltdowns. The causes, consequences and the policy response for these two global economic collapses are different on the surface, but they share some common characteristics in nature which will link them to the idea that all recessions are natural and inevitable parts of the business cycle. In this video, we will illustrate both the similarities and differences of the two crises in terms of their causes, consequences, and respective financial policies.
The causes of these two financial crises have some very similar features, namely the collapse of markets, the transmission of financial shocks, and the failure of the informational capital system. But the concepts and ideas supporting them can be very different. The collapse of markets. Let's first talk about how easy money and over-leveraging give rise to euphoric bubbles. In the case of the Great Depression, the Federal Reserve kept the interest rates artificially low. Americans relied on cheap credit. This fueled strong short-term growth but created customer and commercial debt. We will use the bubble in the agriculture sector, real estate market, and the stock market as examples. In the agriculture sector, during the post-war period, due to mechanization of operations, farmers borrowed heavily to buy new equipment. But rising European production combined with large imports to the America sent prices down, which made debts harder to repay. In the real estate market, the low interest rate environment sets off a massive wave of home construction and hence an asset bubble. For example, in the 1920s, Florida was the site of a real estate bubble fueled by easy credit and advertisers promoting a lifestyle of sunshine and leisure. In the stock market, investors purchase stocks on margin to gain financial leverage. For every $10 invested, a margin user would borrow $9. As a matter of fact, from 1921 to 1929, the Dow Jones rocketed from 60 to 400 due to the speculation and low risk aversion. In the case of the 2008 credit crisis, the global savings glut made the long-term interest rate, nominal and real, to drop due to profound liquidity. For the real estate market, the fall of the real long-term interest rate made the capitalization rate of real estate low. The overheating housing market gave rise to the securitization of mortgage into some mortgage-backed bonds. As mortgage-backed securities market heated up, a constant supply of mortgages was required to produce more MBSs. Mortgage banks were now motivated to lend loans to subprime homebuyers, further fueling the real estate market. All in all, historically low interest rate together with great liquidity and huge legal and congressional pressure on banks to ease lending requirements for low-income buyers motivated investment in U.S. houses. Finally, owing to the attractiveness of MBSs and huge market liquidity, financial institutions across the globe borrowed heavily for investments. Now we will focus on how the bubble burst and led to widespread bankruptcies and the credit crunch, which was intensified by over-leveraging. For the Great Depression, the market values of many stocks were much higher than the intrinsic value that the stock certificates represented, so as that of the real estate and commodities market. Their prices deviated from their economic fundamentals. As signs of weakness showed in the market, investors lost confidence, and a rush to sell stocks occurred in 1929. The collapse of the stock market caused people to increase their liquidity preference, which might lead them to hoard money. Bank run happened, and many of them fell. In the face of bad loans and worsening future prospects, the surviving banks became conservative in their lending. It turned out the money supply in the private market plummeted and real interest rate rose, investment and consumption fell. Deflation happened. Distressed selling of assets intensified deflationary pressures too. This process is known as debt deflation. For the 2008 credit crisis, the case was similar. With the burst of the housing market bubble, as many subprime borrowers defaulted, the value of MBSs and the likes plummeted as housing prices plummeted. Details of the policy response by the authority in these two periods will be discussed later. Let's now talk about the transmission of the financial shock. The two global financial meltdowns were originated from the US and spread across the industrialized countries across the globe. For the Great Depression, the financial shock was transmitted through the gold standard. For the 2008 crisis, the shock was spread through many innovations in the financial system. Before the Great Depression, the gold standard was used in many Western countries to stabilize currency rates by fixing the prices of their domestic currencies. Because the exchange rates were fixed, the gold standard caused price levels around the world to move together. This co-movement occurred mainly through an automatic balance of payments adjustment process called the price specie flow mechanism. When the US encountered deflation, price levels of US goods fell relative to the imported goods. So the demand for US goods increases in foreign nations and the demand for foreign goods decreases in the US. Deflation, falling output, and profit spread away from the US. On the other hand, before a 2008 credit crisis, the rise of MBSs and many other financial innovations tied the world's financial markets together. At that time, the illusion that the US housing market would continue to boom encouraged individual investors and commercial institutions to purchase MBSs and related products. Second, the high rating of MBSs had investors failed to assess the risk accurately. Lastly, major financial institutions, convinced that the federal government will always come out to bail them out in times of crisis. The moral hazard incited them to take risky actions. Finally, let's talk about the failure of the informational capital system. The fact that a large number of banks fell during the Great Depression had led to the destruction of banking informational capital about the creditworthiness of different potential borrowers. The disappearance of many banks implied severely protracted declines in the supply of credit by banks. More banks fell since they failed to borrow to finance their debts and operations. In 2008, the informational capital system became fragile long before the crisis. The complexity of financial products and the lack of transparency of bank assets and risks undermined the assessment on banks' creditworthiness. As the crisis broke out, banks failed to evaluate their counterparts' risk, losing confidence in lending to each other. The credit crunch put the economy to a recession.
Now it's time to talk about the consequences of these two crises. To illustrate the severity of these two crises, one should present the relative changes of main economic variables between the pre-crisis maximum and their onsets. In the dataset below, we will generally use the time period of late 1929 to 1932 for the Great Depression and the late 2008 to 2009 for the credit crisis. The US will be the main focus of the analysis, and the average of various indicators over 10 industrialized countries will be used to construct the world data. We will study the depth of the crisis, the geographical coverage, and the speed of the breakdown. First of all, the depth of the crisis. We see large differences in GDP, prices, employment, and exports. GDP dropped by 10% in the Great Depression, but only 4% in the recent crisis annually. 7 of the 10 selected countries suffered a larger GDP drop than in 2008. In the Great Depression, there was deflation, and in the 2008 credit crisis, there was actually inflation. Employment and world exports also decreased by a larger amount in the Great Depression than in the credit crisis. There are also some smaller differences in the Great Depression and the 2008 credit crisis in the manufacturing output and in the stock market, though both sectors dropped hugely in both crises. The scale of the 2008 credit crisis appeared to be much smaller than that of the Great Depression if considering the variation of the above macroeconomic indicators. Second, we are going to talk about the geographical coverage. In order to do so, we use the magnitude of synchronization. The synchronization is stronger during the recent crisis. During the Great Depression, the drop in GDP was concentrated mainly in 4 countries: USA, Germany, Austria, and France. In the recent crisis, GDP declined in all 10 countries with around 5%. Moreover, greater level of synchronization in the recent crisis is shown for all indicators by a large margin. This all shows synchronization is stronger than the recent crisis. Third, the speed of the breakdown. The speed of the breakdown of economic activity once the financial crisis broke out is measured in terms of the quarterly data on manufacturing and exports during the first 3 quarters. We see that all the results indicate the 2008 crisis had a steeper and faster decline on manufacturing and exports compared to the Great Depression. Finally, we are going to analyze some common macroeconomic phenomena that happened in both crises. First, the liquidity trap. It is believed that the US had experienced the liquidity trap both during the Great Depression and the 2008 credit crisis. In the liquidity trap, the monetary policy is said to be ineffective to kickstart the economy. When nominal interest rate is close to zero, because the opportunity cost of holding cash is zero, even if money supply increases, people hoard money, even if they have more money than they need for transaction. The credit market comes to freeze, no one borrows for consumption and investment. Second, the sluggish credit market. During the Great Depression and in the 2008 crisis, the credit market virtually went dead. The first reason is the liquidity trap. The second is that the information capital system. Third, inflation versus deflation. During the Great Depression, deflation and deflation expectations were high. However, during the 2008 credit crisis, there was no rampant deflation. One possible reason was that wage rigidity made household income relatively stable. Another reason is the appropriate and prompt policy from the Federal Reserve.
Let's now talk about the financial policies implemented after each of both crises. The 2008 credit crisis turned out to have a lesser adverse impact on the world economy than the Great Depression. The reasons for that can be primarily divided into 2 parts: conventional policy response and the effect of other financial policies. Conventional policy response. In the wake of a financial meltdown, the government can mainly pursue 2 types of actions to mitigate the crisis, named monetary policy and the fiscal policy. We should compare some policy indicators for evaluation. For the monetary policy, we will use the money supply, discount rate, and the federal fund rate. For fiscal policy, we will use the budget, deficit, and surplus. Monetary policy. For monetary policy, typically the central bank will adopt open market operations, discount window lending, and reserve requirement as the instruments to pursue an expansionary or contractionary monetary policy. During the Great Depression, money supply decreased worldwide. However, money supply increased between 2008 and 2009 worldwide. In the US, target federal fund rate was lowered in the 2008 crisis, while during the Great Depression it was kept high. In 2008, the Federal Reserve was said to have adopted an expansionary monetary policy. First, it performed open market operations by buying short-term securities to pump cash to the banks and investors. Banks now have more reserves. They can now lend money, and money supply therefore increased. Second, it performed the Operation Twist to lower the long-term interest rate by selling short-term treasury securities and buying the long-term treasuries simultaneously. bond interest rate dropped. The lowering of borrowing costs encouraged borrowing for investment and consumption. Money supply hence increased. The Federal Reserve also performed quantitative easing. Other than encouraging borrowing for investment and consumption, this can help relieve the balance sheet liquidity troubles of these stranded companies and open up some bond market and make them more operational. Finally, the lowering of the discount rate can encourage the commercial banks to borrow directly from the central bank again. During the Great Depression, the Federal Reserve pursued a contractionary monetary policy in the beginning. It performed very few open market operations. They argued that instead of pumping liquidity, it should withdraw funds from problematic banks in order to shield its balance sheet from further losses. The contraction of money supply made the LM curve shifting leftwards in the ISLM graph. The high real interest rate hindered investment and consumption. The quantity of goods and services demanded for any price level dropped. This shifted the IS curve to the left. For the money market, as banks had less capital supply, they refused to lend and raised the interest rate, while others failed to borrow to meet debts. Second, the Federal Reserve increased the discount rate mentioned above in order to curb stock market speculation, which again discouraged banks to borrow from the central bank. We will now cover the fiscal policy. Fiscal policy was not used during the Great Depression to counter the declining economic activity, at least not in the first 3 years. Though after 1932 the US government was back on track to adopt an expansionary fiscal policy, it lost the chance of mitigating the 1929 crisis in the beginning. During the 2008 credit crisis, the US government adopted an expansionary fiscal policy immediately with the enactment of the American Recovery and Reinvestment Act. Fiscal policy was very different between the two. During the Great Depression, governments tried to mitigate or compensate the automatic stabilizers. This time they amplified them by stimulus packages. The gold standard. Because of the gold standards, in the wake of a financial crisis, the central banks had limited control on the money supply. Since the gold reserve in the central bank could not be changed much in the short term. In 2008, there were no countries running the gold standard. Regarding banking deposit insurance, there was no banking deposit insurance during the Great Depression. Deposit insurance was introduced only after 1933. Regarding the informational capital system, many banks failed during the Great Depression, led to the construction of banking informational capital about the creditworthiness of different potential borrowers. They preferred to keep cash as their reserves. This adverse mechanism was largely avoided during the 2008 crisis, since the Federal Reserve either took over insolvent financial institutions or arranged their takeovers by other financial institutions. Finally, about protectionism, we assume it can be measured by the change of share of exports plus imports to GDP. Of the 10 countries we studied, their negative absolute change in share of exports plus imports to GDP were larger during the Great Depression. The Great Depression was characterized by beggar thy neighbor policies. Protectionism was blamed for prolonging and deepening the 1929 economic woes. During the current recession, major trading partners have largely avoided the temptation to take trade inhibiting policies.
After all we've said, we can conclude that humans always make the same mistakes, but we are also able to learn from mistakes. People now call the 2008 credit crisis as an economic recession instead of a Great Depression like the one in the 30s. The major difference will be the implementation of appropriate financial policies and a well-developed financial system today. The demonstration effect of the adverse consequences triggered by such policies during the Great Depression gave a painful lesson to economists and policymakers across the globe. Delightfully, we by far succeed to turn the current crisis substantially milder and shorter than the Great Depression.